Something is broken. Not broken the way markets get noisy on a slow Friday. Not broken the way analysts reach for the word volatile when what they actually mean is confused. I mean structurally, fundamentally, irreconcilably broken between what the paper markets last showed you when they closed on Friday and what the physical markets are screaming at you right now, while the people who run those paper markets are asleep and cannot interfere. And before we go any further, if you have not subscribed yet, do it now, because what I am about to walk you through tonight is not a weekend anomaly. It is not a blip. It is the opening chapter of something that has been building for a very long time, and the events of the last 72 hours just collapsed the timeline considerably faster than most models anticipated. Stay with me, because this gets significantly heavier before it gets lighter. Let me start with the number that stopped me cold when I pulled up the data this weekend. PAXG, tokenized physical gold, running on crypto rails, backed 1-for-1 by real metal. Not a promise, not a futures contract, not a dollar-denominated derivative of a derivative. Real, physical, gold. It touched $6,000 per troy ounce on the dark market this weekend. $6,000. While the COMEX sits dark and silent. While the mainstream anchors are at home watching something other than what is unfolding right now in the markets that never sleep. PAXG is currently trading at $5,400. Friday's Western spot close was $5,078. That is a $124 premium over the last official price the paper system gave you, and that gap is not noise. That gap is where informed money goes when it cannot use the official channels. Now hold that number, because we are going to come back to it, and by the time we're done tonight, you are going to understand exactly what that number is telling you, and why what is happening in the physical silver market in China right now makes that gold premium look conservative. But first, I need to set the stage. Because to understand why the commodity markets are doing what they are doing this weekend, you need to understand two parallel realities that are operating simultaneously right now. And I need you to hold both of them in your mind with equal clarity, because each one alone is significant. Together, they are historic. The first reality is geopolitical. Iranian Supreme Leader Ali Khamenei has been confirmed killed following coordinated U.S.-Israeli airstrikes. This is not speculation. This is not a rumor circulating on social media. This is official confirmation. From Iranian state media itself, from the state broadcaster. The supreme leader has reached martyrdom. Those are the words of Iranian state television. Former Iranian President Mahmoud Ahmadinejad was also killed in a separate strike, confirmed simultaneously by Iranian media and Fox News, two of the most powerful figures in Iran's entire political and military architecture, eliminated in coordinated operations within the same window. When that news broke, there was a calculation being made in certain rooms. The calculation was that the death of Khamenei might trigger a moment of pause, a hesitation in Tehran, a window, however brief, for de-escalation. That calculation was wrong, deeply, catastrophically wrong. Iran did not pause. Iran responded with one of the largest documented missile and drone barrages in the modern era. Here are the specific numbers. Since yesterday, Iran launched 165 ballistic missiles, 2 cruise missiles, 541 drones. Of those, 152 ballistic missiles were intercepted, 56 drones were destroyed in the air, but 35 drones hit land, and 21 of those struck civilian targets just this morning. The UAE has been converted into an active conflict zone, 3 people confirmed killed, 58 injured, representing multiple nationalities, documented damage to civilian homes and property across the region. And then Iran went further. The Iranian Revolutionary Guards confirmed via state media that Iran targeted the USS Abraham Lincoln, a U.S. aircraft carrier, with 4 ballistic missiles. Whether those missiles connected or were intercepted is still being verified at the time of this recording. What is not being disputed is that Iran fired ballistic missiles at a U.S. carrier group. That is not a regional skirmish. That is not a proxy engagement. That is a direct kinetic strike on a U.S. military asset in international waters. Iran's official statement is unambiguous. No red lines remain. The language coming out of Tehran is absolute. Israel has stated explicitly that regime change in Iran is now an explicit operational objective. U.S. bases in 5 countries have been struck by Iranian forces. The Houthis in Yemen have resumed full Red Sea attack operations. This is coordinated, multi-theater, sustained military escalation. Hold that picture in your mind, because now I need to take you to the second reality. The one fewer people are watching. The one that runs beneath the headlines in a language most financial commentators are not trained to read. The one that explains why the data I'm looking at right now is so far outside of normal parameters that even the instruments we use to measure extremes are struggling to keep up. China's Dalian Commodity Exchange issued a formal preemptive liquidity notice before the trading week even began. Read that carefully. China's major commodities exchange issued a formal notice this weekend stating that if a large enough price deviation occurs that depletes accumulated gold liquidity, trading will be closed. Read that again, slowly. China's major commodities exchange issued a preemptive notice about what happens if gold prices move so far and so fast that their liquidity infrastructure cannot contain it. They didn't say if prices drop. They issued a notice about a liquidity depletion event. That is an institution preparing for prices to move in one direction only. And on the physical silver side, what is happening in Shenzhen right now is something that professional commodities traders in the West have almost no framework to process. According to a Chinese commodities trading advisor with direct access to distribution network pricing, the physical silver buyback price premium between small distributors in China's Shenzhen market shot up nearly $20 per troy ounce equivalent over the weekend. That takes the Shenzhen physical silver buyback price to north of $120 per ounce, $120 per ounce for physical silver being paid right now in China. And here is where it becomes structurally extraordinary. Most small Chinese silver distributors are not selling their physical silver at that price. They are sitting on it. The fear is not price collapse. The fear is supply disappearance. When physical holders refuse to sell even at $120 because they believe the price will be higher tomorrow and the supply behind it will be lower, that is not a speculative run. That is a structural break in the physical market's willingness to part with metal at any near-term price. Now look at the full spread of prices operating in parallel right now across every market that stayed open this weekend. IG weekend spot, silver trading near $100, Kinesis silver at 100, Hyperliquid showing 96, Shanghai spot at 105, Shanghai futures at 108, Western spot closed Friday at 93. That is a $7 premium on IG silver over the last Western paper close, a $12 premium on Shanghai spot, a $15 premium on Shanghai futures, and a $27 premium in Shenzhen's physical market over the Western paper price. $27 on the same metal in the same weekend, while the official market sleeps. And this is the question I want you to sit with before I give you the answer. If these premiums are real, and they are real, these are live operating markets with actual transactions clearing, then what is the Western paper price actually measuring? Because if physical silver in Asia is trading at $120 and the paper price closed at 93, one of those numbers is a real price, and one of those numbers is a number that a system produces. I'll let you decide which is which. There is a concept in commodity markets called price discovery. The idea that a traded price represents the equilibrium between genuine buyers and sellers with real access to the underlying physical good. Western paper silver markets have operated for decades as the dominant price discovery mechanism for global silver. But price discovery requires one critical assumption, that the paper price and the physical price are effectively interchangeable, that a paper contract, if held to delivery, can be converted into real metal at or near the same price. When the Shenzhen physical market is paying $27 more per ounce than what the paper market last showed, and when the physical holders in that market are declining to sell even at that elevated price, that assumption is not under stress. It is broken. The paper price and the physical price are no longer describing the same thing. They are two different markets using the same unit of measurement, which is one of the more dangerous conditions a commodity market can enter. Now, before I take you to the Strait of Hormuz and show you something about global energy infrastructure that recontextualizes every oil price you have looked at for the last decade, I want to do something that I believe separates honest analysis from narrative construction. I want to give you the resistance case. Because if I only showed you the data that confirms the bullish thesis, I would be doing exactly what I accuse the mainstream of doing with the bearish thesis. So here it is, clearly and without dismissal. Weekend precious metals premiums are historically elevated relative to weekday trading. Crypto-backed tokenized gold and silver markets are thinner in volume than the primary paper markets, which means prices in those venues can reflect panic and positioning rather than true price discovery. The $27 Shenzhen premium, the $124 PAXG premium, these are real prices being paid, but they are being paid in markets where the volume of counterparties is smaller and the capacity for large arbitrage-driven corrections is higher. When Western futures open, the mechanics of arbitrage can, and have, compressed these premiums rapidly. We have seen this pattern before during geopolitical spikes. Iranian strikes, as severe as they are, could de-escalate faster than current positioning implies. A diplomatic backchannel could activate. If both sides overplayed their hand and a ceasefire emerges within 48 hours, the premium compression in metals could be violent. That is the honest bearish case. Hold it alongside everything else. Now, the Strait of Hormuz. Roughly 20% of global seaborne oil trade flows through a single choke point in the Persian Gulf. 20%. That number alone is large enough that even a partial disruption has historically moved global oil prices. What is happening right now is not a partial disruption. It is a functional freeze. And the mechanism by which it is freezing is not military force alone. It is insurance. Every commercial vessel transiting the Strait of Hormuz purchases war risk insurance. This insurance protects shipping companies from the financial consequences of attack damage, as long as insurance is available at a cost that makes commercial voyages economically rational, ships sail. When insurance becomes either unavailable or priced at a level that destroys the economics of the voyage, ships stop. They don't need to be sunk. They just need to be uninsurable. 2 vessels have been attacked near the strait in the last 48 hours. A Palawan-flagged oil and chemical tanker struck near Ras Al Kasab at the entrance of the strait. 4 crew members injured, 20 crew members evacuated. A second vessel struck in the same zone. Both vessels on fire near the Strait of Hormuz. The insurance market responded immediately. War risk insurance for a $100 million oil tanker transiting the strait jumped from approximately $250,000 per voyage to $375,000 per voyage. That is a 50% premium increase on a single risk category in under 48 hours. Maersk, one of the largest shipping operators on the planet, has suspended all Strait of Hormuz transits. 150 tankers have dropped anchor in open waters. Oil and LNG carriers sitting motionless off the coasts of major Persian Gulf producers, refusing to move. 20 million barrels per day of oil flow, functionally frozen. And 100% of Qatar's world-leading LNG exports, which Asian economies depend on for energy security, suddenly blocked. Brent crude is trading up 8 to 10% this weekend, around $80 per barrel. Weekend prices holding, not giving back gains. A violent negative supply shock to the most critical energy infrastructure on the planet. And the oil price is staying elevated even without the leverage of weekday futures volume behind it. But Iran's strategy is not simply to close the strait. The strait closure is one component of something more architecturally sophisticated. Iran is demonstrating that they understand the difference between sinking ships and igniting infrastructure. Consider the specific target selected. Iran struck Duqm in Oman, a port specifically designed and constructed to bypass Hormuz risk, giving Gulf oil exporters an alternative route if the strait became impassable. That alternative route is now a target. Iran struck Jebel Ali in Dubai. Jebel Ali handles 60% of the UAE's imports. It is not an oil terminal. It is the commercial and logistics backbone of the UAE's entire non-oil economy. Drone hits on Jebel Ali's crane infrastructure means containers stop moving, supply chains fracture, and Dubai's economic function degrades, independent of whether oil flows or not. Iran struck Mina Salman in Bahrain, home to the U.S. Fifth Fleet, demonstrating that the line between military and commercial maritime infrastructure has been erased. They struck Haifa in Israel, which manages critical energy imports into the country. This is textbook asymmetric warfare doctrine executed at an infrastructure level. A carrier group can protect a sea lane. A carrier group cannot protect every crane at Jebel Ali from a drone swarm arriving from a direction you didn't anticipate. Patriot missile systems are optimized for ballistic threats. Saturating drone attacks on commercial port targets are a different equation entirely. Iran is not fighting the U.S. Navy in the strait. Iran is fighting the global economy at the ports. The nations most exposed to this are the ones least capable of absorbing it. Japan relies on 75% of its oil imports passing through the Strait of Hormuz, and is close to 100% import dependent on oil overall. Japanese tankers are already turning back. South Korea gets 60% of its crude through the strait. India sources approximately 50% of its crude imports through Hormuz, roughly 2.6 million barrels per day from Gulf states alone, plus 60% of its natural gas and LNG supply. For India, this is not an abstract price shock. This is fuel prices spiking, the rupee coming under direct pressure, and GDP growth taking a direct hit in real time. China is the largest absolute buyer of Hormuz crude, at 55 to 60% of its total crude imports transiting through the strait. China has partial diversification through Russian pipeline supply, which gives it some absorption capacity, but absorbs better than the others does not mean immune. It means China takes a massive price hit and survives it, while Japan and South Korea struggle. And underneath all of this, separate from the geopolitics, separate from Hormuz, separate from the weekend premium in Shenzhen and the PAXG price, the structural fundamentals that were already breaking the silver and gold markets before any missile was launched this weekend have not changed by a single data point. This is the section of the analysis that gets the least attention, because it doesn't carry the dramatic weight of drone strikes and carrier group attacks, but it is arguably the more important half of the story. Because geopolitical events end, conflicts de-escalate, insurance markets recalibrate, but a structural supply deficit in a metal that the global industrial economy depends on does not resolve on a diplomatic timeline. It resolves on a mining timeline, and mining timelines are measured in years, not weeks. Silver has closed green for 10 consecutive months, not 10 consecutive weeks, 10 consecutive monthly closes. Green. Gold has set a 7th consecutive record high. Shanghai maintained a persistent premium before this weekend's $12 widening. Before the Shenzhen physical market's $27 premium, Shanghai was already trading above London. Silver lease rates, the cost of borrowing physical silver for short-term delivery, spiked for 6 straight days before this weekend began. 6 days of rising lease rates means the people who need to borrow physical silver to make delivery on existing paper commitments are finding it harder and more expensive to locate real metal. And industrial demand has not paused. It is not pausing. Solar panel manufacturing, electric vehicle production, AI data center construction, 5G network build-out, military and defense electronics, nuclear energy development. All of these are silver-intensive, and all of these are expanding simultaneously. A single solar panel contains approximately 20 grams of silver. Global solar installation is on a trajectory that requires hundreds of millions of panels per year. Modern EVs use roughly 25 to 50 grams of silver per vehicle for electrical systems alone. AI data centers require silver-intensive server components at a build rate that didn't exist 3 years ago and is accelerating. Every one of these demand curves is growing. Mine supply, constrained by permitting timelines, energy costs, geological limits, and capital cycles, cannot respond on the same timeline that industrial demand is growing. This is not a price spike waiting for supply to catch up. This is a decade-long repositioning of where silver sits in the global industrial hierarchy. Now, let me bring everything together, because this is where I want you to pay the sharpest attention of everything you've heard tonight. The gap between what PAXG is trading at and what the CME last showed you on Friday is $124 on gold. The gap between what Shenzhen is paying for physical silver and what the Western paper market closed at is $27. These are not noise. These are not fear premiums that evaporate with a ceasefire. Even in the scenario where a ceasefire materializes overnight, even if diplomacy interrupts the military timeline, the lease rate spike was happening before the strikes. The Shanghai premium was persistent before the weekend. The 10 consecutive monthly green closes on silver happened before Iran launched a single drone this week. The structural deficit does not require a war to maintain its trajectory. The war accelerated the timeline. It did not create the thesis. Those 2 sentences are worth reading twice before markets open tonight. When Western markets open, there are specific things to watch with precise attention. The gap size on gold and silver futures, whether it opens at $50, $100, or $200. The number itself matters less than the direction of the move in the first 30 minutes after the open, because that tells you whether institutional positioning is confirming or fading the weekend premium. A gap that opens and holds for the first 30 minutes is a fundamentally different signal than a gap that opens and immediately fills. Watch whether the Shanghai premium on silver widens past $27 or compresses toward the Western paper price. If Shanghai widens further, the thesis strengthens in real time. If it compresses, it means arbitrage capital is flowing in sufficient volume to close the gap, and the weekend price in Shenzhen reflected a thinner market than the structural case requires. Watch strike duration. Iran stated that operations continue for days as an explicit policy position. Every additional day of confirmed operations keeps the insurance premium elevated, keeps those 150 anchored tankers in place, and prevents the 20 million barrels per day of frozen oil flow from resuming. Watch whether Hormuz closures expand to additional insurance categories or stabilize. If war risk coverage for VLCC supertankers becomes fully unavailable rather than merely expensive at $375,000 per voyage, the oil supply equation changes category, not just degree. There is a threshold between expensive to insure and uninsurable, and that threshold is where the oil market goes from a shock to a crisis. Watch whether Brent holds the $80 level or gives it back in the first 2 hours of trading. Holding means the physical oil market is confirming the signal coming out of the tanker anchoring data. Giving it back means paper positioning is dominating over physical reality, and we're in a compression phase before the next leg. And here is the structural reality that no compression wave can change. Physical buyers in Shenzhen paying $120 for silver are not going to sell at a loss because a paper market opens in Chicago at 95, The economics of that trade don't work in reverse. The arbitrage does not run from expensive to cheap when the cheap price is in a market that cannot deliver the physical metal you need for an industrial process that cannot stop. You cannot halt a solar panel production line, tell the buyer you're waiting for the paper premium to compress, and expect industrial demand to pause politely while that process plays out. It doesn't work that way. Physical industrial demand is not a leveraged trade you can unwind. It is a manufacturing commitment you have already made on equipment that is already running. Gold is likely to lead the next move in precious metals given the scale of safe haven capital flow we are seeing from multiple directions simultaneously. Precious metals markets are likely to gap higher when trading opens tonight. We will see by how much. But here's what I keep coming back to, and I want to leave you with this before we close. China ordered its citizens to evacuate Tehran. $650 billion was added to the metals market cap in recent sessions. Insurance markets priced 150 tankers out of the Strait of Hormuz in under 48 hours. Iranian state media confirmed 2 of the country's most powerful figures were killed in coordinated strikes. And the physical market for silver in China's largest distribution hub is paying $27 more per ounce than the Western paper market's last closing price, while most of those physical holders refuse to sell even at that premium. Every single one of those facts came directly from the data, not from interpretation, not from a thesis I was trying to sell you. The data said it. I read it out loud. Now, here is your question, and I'm not going to answer it for you, because the answer is in everything you just heard. If physical markets and tokenized metals traded all weekend showing you where informed money values real metal when paper markets cannot interfere, and those prices are $124 above Friday's gold close and $27 above Friday's silver close, and a Chinese state exchange issued a preemptive notice about gold liquidity depletion before the week even began, what exactly is the paper price on Monday morning a price of? Think carefully about that question, because the answer determines how you see everything that comes next. If this gave you a sharper view than what you got anywhere else this weekend, you know what to do. Share this with someone who needs to see it. Subscribe. And stay close, because if something significant breaks before futures open, another video goes live fast. The war accelerated the timeline. It did not create the thesis. Be smart. Invest smartly. Never impulsively. Follow the data. Protect your position. The data doesn't lie. People do.